Steve Kolano, Chief Investment Officer at Integrated Partners. What is your view on the recently announced Federal Reserve interest rate path?
I have to say it makes a lot of sense. I think given the softness that as Chair Powell mentioned in the news conference and we've seen in the headlines, we've seen in the data, not only non-farm payrolls, but we've been talking to our advisors for quite some time now about the decline in the U.S. hiring rate that's really been in place since late 2022, now at a rate of around 3.3, 3.4%. Given that softness in the labor market that we're starting to see, the risk, I think, has shifted from, despite tariffs still kind of in play, the risk has shifted to, all right, let's make sure we keep an eye on the full employment objective. With that risk shift and the balance of inflation risks from tariffs, I think the 25 basis point rate cut did make a lot of sense. And as we see, there's still dispersion and kind of further out. But right now, I think it's a good starting place, and more importantly, maybe right in line with what the markets were expecting, with close to a 97% probability going into that rate cut of 25 basis point rate cut. So it met the market expectations, and I think so far we've seen the markets respond well to it.
With that in mind, how might wealth and asset managers think about that in relation to investor portfolios?
Yeah, a couple of different facets. Not only what we've been talking about and doing internally, but I think broadly. I'll say the first one is probably on the fixed income side of portfolios. We've been shorter duration for quite some time, and I think given the uncertainty around not only inflationary pressures, but the dispersion of outlook from the summary of economic projections, and still the shape of the yield curve, while it's steepened, you're still seeing decent yields at the shorter end of the yield curve. And so for that reason, I think tilting more towards shorter duration continues to make sense. We've been there for a little while now and probably will maintain that. In other parts of the portfolio, not so much international equities, but places that benefit from a weakening dollar, given not only the interest rate policy that we're starting to see and project on, but also potential for inflationary forces there. Emerging market debt starts to become a little bit more interesting. And then in particular, I think most places, and I'll say including us, have been maybe a little bit underweight small caps relative to large caps. So far, large caps have held up their leadership, but we are, in response to that interest rate cut, we're starting to see small caps go on a little bit of a tear. Going forward, those are probably small caps, high yield, and gold, probably in that combination, are some of the areas that we're watching really closely as if policy continues to ease. Because I think small caps in particular, while they benefit near term from easing monetary policy, given the leverage that a lot of small cap companies have on their balance sheets in relation to larger cap companies, at some point, the catalyst shifts from policy, interest rates, and debt service to outright economic growth. And so going forward with the softness we're seeing in the labor markets, I want to continue to see small caps outperform going forward to confirm that markets are still expecting growth to maintain, growth still to be positive and not to roll over. So small caps become pretty interesting for us, emerging market debt, and even cyclicals and value, right, which all started to see. So that seems to be a shift away from the large cap growth dominated effect that we've seen probably for several years now. I want to see that shift going forward, and we're starting to pay more attention and bring some more of that exposure into our portfolios in reaction to or in relation to the expectation of further easing policy.
Steve, fantastic insights. Thank you for your time.
Thank you, as always.